It all depends on what your long-term strategy is. It really does. So part of what I'm going to talk about right now, I'm going to talk about strategy. And the answer to that question can be different for every person in this room. It just really depends on what your goals are. Some clients are good with saying, you know what, I'm just going to flip property, I'm going to pay my tax, and I'm going to keep going. Some clients are good with that. Some clients are good with flipping property, buying another piece of property, getting a rental income. It just depends on what your goals are and just how detailed you want to be, how much effort you want to put in to reduce your tax bill. And as I go through this next conversation, you will understand exactly what I am talking about. So, if you are flipping property, I want to talk about the tax implications of flipping property. Typically, your first flip that you guys do on your tax return, it is typically going to just be treated as a sale of a piece of property. You sold property, it's going to get hit with capital gains rates. If you're in and out of that property in less than a year, it's going to get hit with ordinary income tax rates. Okay, you guys with me on that? Ordinary income tax rates on your personal income tax return. Something for you to know. Typically, if you are flipping properties and you are in a flip for over a year, I don't know that your flip game is where it needs to be. You know what I mean? Like, we need to be in and out of that property unless it's a bigger piece of property and there's a reason why you're holding it for that long. But flips are usually short-term holds. Are you guys with me on that? Okay. Now, if you decide to make flipping properties a business, because I have clients that do that. They're acquiring real estate every single day, they're rehabbing, they got one in escrow, they're selling. This is literally a business. If that is what you're doing, you no longer qualify for capital gains. This is actually a business. This is no different than you selling clothes. The properties are now your inventory, and you cannot deduct any of the costs associated with that flip, except for it's a basic operating cost, until that property is sold. It's considered carrying costs. And there's a tax code 263 cap A, and when I say cap A, I mean the capital letter A, because there's a 263 small a. 263 cap A says that you cannot deduct the cost of that property until you sell it. It's inventoriable costs. So if you really want to get into the flip game, you got to make certain that you know what you're doing, because you can end up spending a lot of money and not able to deduct the cost. Are you guys with me on that? And then have to carry that and carry it and carry it, and you wind up running out of money. So it's really important that you understand the tax implications. Now, someone asked me about entities, and depending on what you're trying to do, and I'm going to say this with a very light hand. Do not quote me on this. Don't say Karla said this was my strategy, because this is not your strategy. This is what I typically see. Typically, if you're going to flip, you want to flip inside of an S corporation. You typically don't want to flip as a personal individual. Does anybody know why that is? Anybody? What was that?
Liability.
Liability. Flips bring about the biggest liability, right? Because typically you covering up something with some paint or some flooring or something. You're just trying to get out quick. So it brings about a lot of liability. So if you flip as an individual, you're typically going to, if something happens, it's going to boomerang back to you as an individual. Yes?
You said they have to be flipped on the S corporation.
I didn't say you had to flip in an S corporation. I said typically.
Not S corporation.
Right, S corporation.
S or C corporation.
Right.
Okay.
Typically, those are the best vehicles to flip in. But again, it depends on your unique strategy. So I don't want to blanket and say everybody in here that's going to flip needs to be in an SRC. I'm not going to say that. Maybe. It just depends on what you're trying to accomplish, how many properties you plan to flip, because there's costs associated with running corporations, right? There's paperwork associated with running corporations. So we want to make certain that we evaluate the cost-benefit analysis of whatever it is that we're going to do. Does that make sense to you guys? Okay, very good. So I really feel like we are in such a disruptive marketplace right now. I really do. I feel like there's a lot going on from a political perspective. We just had a major tax overhaul. The real estate market in California is up, up, up. I just think we're in a very disruptive time period. I feel like that it's incumbent upon you as investors to stay current on what's happening. If you're current, you're still behind. I think you got to be a visionary and you got to start reading and see what's coming. That is my job as a strategist. I am always looking ahead. When that tax law change was coming, I had already read the House report. I had already read the Senate report because I needed to see what was coming ahead so I could educate my client. It's so important because you could be making a decision today, a law is changing tomorrow, something's getting ready to happen in January that can turn your plans upside down. So it's so important that if you're going to be an investor, that you stay engaged in the conversations, which is why we do this on a monthly basis. All right? And if there's topics that you guys want to hear, let us know. We're definitely going to cover those topics. But I want to talk to you about strategic tax planning. You can make money off real estate. You can make money off owning a business. You can make money off of flipping stock. I am not impressed by gross income. I'm not impressed by gross income. You know what Karla Dennis is impressed by? Does anybody know? I'm impressed by net income in your pocket that you can spend on your investments. That's what I'm impressed by. When people tell me, oh, Karla, I made $1 million this year, I'm like, okay, that's great and groovy. But how much are we keeping of that money? And I think that sometimes we're so focused on making money that we don't take the time to stop and strategically plan to reduce our tax bill. And I'll give an example of that. I had a client, he made like $1.1 million. Came to me after he made his $1.1 million, and when he got done with his tax bill, his $1.1 million went to $357,000. You see what I mean? So not having a strategy, your $1 million may look good, but it may not feel good when you're cutting those checks to Uncle Sam. And the last I checked, when I was making money, Uncle Sam wasn't helping me. So I need to get him out of my pocket legally. So how do we do that? The way that we do that is we need to put together a tax plan, really put together a tax plan. And a tax plan is not about being at the end of the year and donating money to charity, although I think donating money to charity is a good thing if you can do that. That's not tax planning. That's giving a donation at the end of the year, and that's fine if you want to do that. But if you give away all your money, what's going to happen? Anybody? You don't have any money to invest, right? So when I hear people saying, oh, I'm at the end of the year and Karla, I'm going to buy some equipment and I'm going to donate all the money to the church, and nothing against the church, but I'm thinking to myself, okay, well, where's your money to invest? I don't think that that's the strategy to employ from the very beginning. What we need to do is get organized. We absolutely have to get organized. And some of us may not enjoy the whole organizational part of it, but I will say to you, the people that organize their records, the people that literally know where they are from January 1st to right now today, the people that are anal about tracking their records are the people that save on their taxes. You may say to yourself, you know what, Karla, I don't like doing that record keeping. Like, it stresses me out to hold paper. I get it. But there are so many different apps that you can utilize to track your paperwork. MalIQ, Bill.com, Receipt Bank. If you have a smartphone, I see them out on the tables. If you have a smartphone, you have the capabilities to get yourself organized. That's so important, because if you want to be an investor, you got to see what's happening with your money, right?